Are you looking for a way to help your brick-and-mortar business drive more traffic and increase your sales? Look no further than the Receipt Paper Podcast. In this podcast, Joanne and Kyle provide their sage advice on how to make your brick-and-mortar store the hottest spot in town. Whether you're just launching a new business or trying to grow an existing one, these informative episodes will leave you inspired. In each episode, Joanne and Kyle take on a different topic related to running a successful business. They offer practical tips based on their own experience as owners of multiple brick-and-mortar locations. So whatever challenges you're facing, they have actionable advice for you. From finding a location and executing your build-out, to merchandising and customer experience, to sales and marketing, Joanne and Kyle have you covered. With helpful advice from these experienced entrepreneurs, you are sure to learn how to increase your sales and have your business running out of receipt paper in no time. Let's dive right in.
Welcome, everyone, to the Receipt Paper Podcast. I am so excited about today's guest speaker and topic. Today, we'll be diving into one of the most asked questions we get, which is how the heck do you fund your business? Today, we'll be speaking with Darrell Hornbacher from Midas Financial, and I am really thrilled for you guys to hear from him. We connected via LinkedIn a couple of months ago, and usually when people reach out about business financing, I'm not too excited to talk to them. But after I had a conversation with Darrell, I realized this was a totally different process than I'm typically used to when people reach out. He really takes a lot of time and puts his clients first, and had a lot of experience and background, and I learned so much. So Darrell has already spoken with our Brick and Mortar Academy members. There was incredible feedback from them, so wanted to bring him on to the podcast. So Darrell, I hope that was an okay intro, but how are we doing today?
I don't deserve that much, but thank you. I'm doing wonderful.
Awesome. If you just want to start off by sharing with our listeners just a little bit about who you are and your company, that would be great.
Yeah, sure. So the abridged version is, because I tend to talk a lot, as you know, but I'm excited when I get excited about a topic, and I've been excited about this topic of money and entrepreneurship and business ownership for going on 20 years. And prior to that, I owned 13 different businesses myself. And that's kind of the story within the story, is that the one constant as I was buying and selling businesses, by the way, I got fired from my first and only job due to insubordination. And I talked to my grandmother, who was somewhat well-to-do, and she said, "Yeah, you're not a worker bee, you're a director. And every job you get, you're going to get fired from. So let's start your own company." And I'm like, "Oh, how do you do that?" And thankfully, my grandfather and my grandmother were entrepreneurs, and I had owned a business for like 30 years. And so she actually helped me a lot. And so we went on this, and I was by no means a Michael Milken or anybody like that, but we would go out and buy distressed businesses. I would fix them with her help, and then we would sell them at a profit. And the one constant was always money or lack thereof. In every deal I ever did, it was all about money. And it culminated when my brother and I were in business, and this is 2001 through 2003. And we were in business and we weren't getting along. And it was more important, our familial relationship, than any amount of money. So we decided to sell the business and split the money and go our separate ways. We put the business up for sale, and it wasn't worth a lot of money. It was like $500,000 or $600,000. And the business broker that was selling it said, "Look, if you can go buy this piece of equipment, it will quadruple the value of your business, because you'll have all this other revenue." And it was a commercial laundry. So he had inside track on a linen, hotel linen contract that was come available that was worth a lot. So we
Wow.
went to the bank, and mind you, I had an 800 credit score. I didn't know what that was, but I at the time, but I had an 800 credit score. And I had a $300,000 house, which at that time was a good house comparative to today. And I had a $100,000 vehicle that I owned outright. So I went to the bank, and they were like, and I needed $125,000, and they're like, yeah, no. And I'm like, well, why not? Well, we'll give it to you, but you have to secure it with your house and your car and whatever. And I'm like, well, I better talk to my wife. And of course, my wife says no. And that's it. And a couple of days later, a young lady walked into my office, and she's like, I sell money. And which I still use that today. My friend Humberto and I were just talking this morning about it, and I'm like, I still use I sell money, and I'm like, well, that's really good, but I don't qualify. Excuse me. And she said, well, why not? And I told her the story, and she says, I'll have you your $125,000 in 72 hours. And the story ends there, that she did get me the money. And I had to pay her a commission of like $3,500. Little did she know I would have paid her 10 grand.
Right.
But we got the money, and we got the contract, and 3 months later we sold the business for a couple $1 million. And I now had nothing to do, and I said, hey, let's talk, because I had in the interim of all this, I had given her a couple of my business owner entrepreneurial friends her name, and she got them money too. So I met with her and took her to lunch, and I said, look I'm going to do what you're doing, and I don't want to step on your toes or anything, but there's a biz op here that I think is pretty big. And I'm gonna do this with your help or not, but I want to give you the courtesy, professional courtesy of doing it. And she says, funny thing, I'm pregnant. My husband wants me to quit working. Give me $3,000 and I'll teach you everything I know. And that's how Midas was formed. That was the onset of the fix and flip, which has taken the country by storm the last 10 years and created millions of opportunities for a lot of different people. But again, just like when I was in business, buying and selling, the one constant was nobody could get any money. It's,
Right.
Unless you want to pledge everything you owned, including your wife and firstborn daughter, you're not getting any money. So we figured out the unsecured markets, and with the help of a couple of my key employees at the time, we were the people that developed the unsecured business credit card stacking platform, which today is responsible for almost 25% of the capital that is obtained by entrepreneurs, especially startups. There's no money anywhere for startups, but if you've got a good credit, I can go stack you a bunch of credit cards that will have a cumulative total of as much as 200 grand.
That's huge.
It's huge. And if you look at, this country's a mess financially, and the only way we're not going to get out of it via taxation, or it doesn't matter what anybody tells you, it's all lies. But entrepreneurship and starting businesses and creating jobs is the only way we're getting out of this. But yet they won't give you the money to do it unless you're jumping through every hoop imaginable. Right. And so consequently, now what and I say I invented, so we created the first platform, whatever that means. But when we published the first websites on the internet via this capital obtaining method. And right now there's 20,000 people just in this country that sell what I sell. Now, I should have trademarked the doggone. Had I
You
done
should.
that, you and I wouldn't be having this conversation. Well, we might have been, but it would have been from my villa on the ocean in Barbados,
Oh,
right?
no.
So that's probably the biggest mistake of my life, business-wise. But we still enjoy an incredible living, and we help. I mean, I personally like being a salesman. I'm like the head salesperson for our company. I have to do the butcher, baker, and candlestick maker stuff that I don't enjoy, and paychecks and whatever. But I'm on the phone selling all day, and I love it. And I have a lot of fun doing it. And I meet the most. I mean, the people I've met in just this week have ranged from a gentleman that tunes organs for churches and needs $25,000 to do something, to a entrepreneur out of St. Louis that has 5 different companies, each grossing 7 figures. To I actually just got a phone call before we were going on of an adult novelty store, for crying out loud, So
I love it.
There's all this stuff, and it's so exciting. I get so excited about what really makes America tick. And America is so big. You don't realize how big we are until you start seeing, you see the same thing every day with what you do. People come to you and say, I want to start a business, but guess what? Nobody's ever taught me how. How do I do it?
Right. Yeah, we don't learn these things.
There's my story.
I love it. I love it. Incredible. I love what your grandmother told you. That was great.
She was spot on. I mean, what happened is I got to work for a really famous company, Fortune 100 company, and I sold industrial equipment and solvents for them. And I started a side, back then this was not a word or a phrase, but now today we would call it a side hustle. When I would sell these manufacturers new equipment, then they'd have to get the old equipment hauled out, and 90% of the time the old equipment was still usable. So I would say, can I have it? I'll be a nice guy, since you're buying this from me, I'll arrange to have it hauled away for you.
There you go.
And then I would resell it. And then when it got to the point where I was making more money doing that than my regular job, and my boss comes to me and says, I never forget, he says, this is insubordination, and we won't allow this.
Yep.
And
you're a true businessman at heart.
I mean, so that was it. And he says, well, I hate to do this because you are a really good salesperson, but I have to let you go. And I said, you knew before you even came here you were going to let me go. He said, yeah, I did. And that was it. And I've never had another job since. And that was meant to be in 1985.
Wow. Love it.
30 years. So anyway.
Incredible. Well, Darrell, let's take a step back and dive into, because I think a lot of our listeners that are just getting out there and saying, okay, I need funding, I don't even know where to start. Can you talk to us about the difference between secured and unsecured funding? Because I don't think a lot of people even know that there's options like that out there.
Okay. So secured funding would be your SBA stuff, your equipment leasing, your commercial real estate, where you're asking someone to give you a loan and you're pledging as security or collateral an asset, a hard asset. It could be intellectual property. It's not a hard asset, but it is an asset if it's recognized, so on and so forth. And that's what we ran into with my brother, is they wanted us for this lousy $125,000. They wanted us to pledge our house and our cars and everything else. And we didn't. Our wives wouldn't let us do it. Unsecured, on the other hand, is you simply walk into a lending institution and you pledge that you will make these payments back, and they look at your credit score, which determines your character in their eyes, and they will then give you the money. And it's responsible for, I don't know, probably 40% of the financial transactions in this country are unsecured. I've never even looked, that's a really brought up a really good point, because I've not thought about even looking that up, but I'll bet you that 25% of it is business credit cards. We all already know business and personal credit cards. We already know that. So I would add, another 15%, I think would be real close. But a secured credit, literally, I think we talked about this last week. You can go out, you can stack $200,000 of these credit cards and decide, after all, you don't want to start a business. You want to go be a beach bum in San Diego, where my friend sitting here, Humberto, is from, and you want to be a surfer bum, but you want a Ferrari. So you go buy the Ferrari, and you just go bad on all these credit cards. And this isn't what I teach, obvious, mind you. But you go bad on all those credit cards, guess what? They're going to wreck your credit, but they're never going to take your Ferrari because you didn't pledge it as collateral. So that's the secured, unsecured scenario.
Right, which is super valuable when you're, I think one of the biggest things we hear from people when they're getting started in brick and mortar is, it's a big risk. Is this going to work? Or how long is it going to take for it to work? And that kind of takes some of that worry away that, it's okay.
80% of businesses fail in the first 2 years, 90% in the first 5 years. Those are pretty common numbers. So, if you can mitigate any personal damage because the business failed for whatever reason, but the more you can mitigate, the better off you are. This day and age, I can legally take anything off a credit report within 30 days of the event. Somebody gets a discharge bankruptcy today, by September 15th, I have it off their credit report.
Nice.
They're not going to like the price they have to pay for it, but guess what? They get to start over.
Yeah.
So, yeah.
Absolutely. So for these, new business owners, they're just building their business plans, they're scoping out their budgets, and they're ready to get funding. Where do you recommend they start? What's the process like? Can you walk them through that?
Yeah, so the first thing you need to do is make sure your credit is impeccable, or as impeccable as you can possibly get it. Lenders look for a few things. And remember, a credit score is nothing more than a gauge of an odds gauge of what are the odds you're going to go 90 days late or more. That's all it is. Anything else anybody tells you, forget it. It is the odds of you going 90 days late or more, because after the 90th day, they write it off and they charge it off, right? So they're going to look, and obviously the higher the credit score, the better. They're also going to look at what kind of income you have, and many from your other job that the vast majority of people I talk to that are opening up a business, they have another job, and they're typically getting downsized from Boeing, GE, or GM or something like that. But they really, the banks will really look at, do you have an income while you're starting this business? How are you going to pay your bills? They really want to know that. That's really important. The next thing they'll look at is what lenders have extended credit to you already, and how much have they extended you, and how responsible have you been with that money? For example, we look in the credit card stacking to get the maximum limits. We need a client to have at least 2 cards that are $5,000 limits or more. And their credit utilization ratios on those cards needs to be, it used to be 50% or less. A year ago, they moved it to 40% or less. Now it's in the 30 to 35% or less. So if you have $1,000 limit credit card and you charge $350 on it, you're at a 35% limit. And they want to, the more that you have and carry on your credit cards, that's not looked at as being pragmatic in building a business. It's looked at as you are are not doing what you're supposed to do. It's kind of ironic. There's a lot of irony there, but they'll look very close. And your credit utilization ratio, quite frankly, is 30% of your credit score. I deal with people every day. We just dealt with one this morning that we were on the phone with, and his score was in the 680s. And then something happened in his family that he had to use his personal credit cards. He maxed, I don't know, he didn't tell me how many, but I'm going to assume that he maxed out at least 5 and maybe 7 or 8. And that 680 score this morning, he says, you can't get me money until next month when I paid all this down. It went down to 535.
Yeah.
So the lenders really look at your utilization as a measuring stick of your future capability. Nobody wants to be the straw that broke the camel's back, if that makes sense.
Yeah.
So
I know a lot of people are probably wondering now, what do you consider a good enough credit to apply for funding? Do you have a range? Where should they be at?
yeah. So remember, there are 17 different types of credit facilities available to entrepreneurs and small business owners. We've established that almost 25% is credit card stacking. And the other 3/4 of the pie are split equally, let's just say, for the sake of this conversation, amongst the other 16. So there are different requirements for each one. So then you have to get into the unsecured and the secured, like SBA is typically a secured loan. Equipment leasing is typically a secured loan. Commercial real estate purchase is always a secured loan, and so on and so forth. So, but we look at, for our purposes, for the card and loan stacking purposes, we need to see a 680 FICO score or better.
Mm-hmm.
And obviously the higher, like we had this gentleman I talked about that had 4 different businesses, all doing 7 figures a year, and he's profitable. He was just that type of guy. You knew he was doing well. And I said, so let's get the elephant out of the room, because that's how I start every conversation. Well, first I want to know about my client. Tell me about you, because I really am interested in people a lot. Then the next question is, let's get the elephant out of the room. What's your credit score? And he said the same credit score as mine. He says, well, I just checked it the other day and it was an 841 FICO score. I'm like, okay, conversation's over. He says, we haven't even started yet. I said, just tell me how much you want and I'll go get it for you. And that was it. And he's like, it's that simple. And I said, yes. But the moral of the story, or the story within that story, is the higher the credit, the more apt you are to having acceptable ranges in each of the little indicators that they have. Your credit utilization, if you've got an 841 credit score, you haven't been late on anything or had a collection or charge off in 5 years. You just haven't.
Yeah.
So that's kind of answers that.
Yeah, absolutely. What advice do you have, or I know, don't you offer some resources for people that are wanting to work on their credit and get it to that point?
Yeah, we do. And so we used to be huge into credit repair. And we found ourselves and we're still in it, but we limit it to our clients only. We don't take consumer credit repairs we will, depending on the story. If they have a compelling story, single moms, I have a natural pension in my heart for single moms because of why they're single moms and and stuff. So single mom, heck, usually I'll do the credit repair for free. Just give me your stuff. And I did that, I think, 5 times last month. I'm like, you can't afford to pay me anyway. I mean, here's the stats. I just looked them up this morning. The average single mom in the United States of America earns $32,586 annual gross, and then she can add an earned income credit on top of that of $2,043. So the average single mom in the United States of America makes $34,629 a year. And you're raising at least 2 kids as a rule.
Wow.
So, and those are the people, and I'll give you a real side note there, because if there's females listening to this, when my company was big, pre-crash, we had 100 employees. 73 were salespeople, and 72 of them were single moms.
Wow.
And people would say, why are you doing this? And I said, well, first of all, women buy from women more often because they trust. Men buy from women because they're men. But the biggest part of it is that single moms can't fail. There's no option in their life. They cannot fail.
Wow.
And my average single mom, the highest paid, and remember, these are in 2005 dollars. So extrapolate that out to today with higher fees we charge and the dollar and stuff. But I paid one young lady $245,000 a year. That's how much she made, commission only. And my average sales person was making 118 or 119. I can't remember exactly what it was, but a whole bunch of money.
Awesome.
And today that 245,000 is probably worth 550, and so on and so forth. But I know I got off on a tangent. I'm sorry.
No, I love it. Those are some great
questions. What was the question again?
Yeah, so I think just for those people that are maybe worried, like, oh, I don't have a good credit score, I can't even get funding. Like, I just want them to know, hey, you can still start somewhere.
So the first thing you have to remember is 95% of the credit repair companies out there are con artists. 95%, no question. Anybody that tells you anything different, they're not telling you the truth.
Right.
And 99% operate outside of the federal and state regulations. That's a lot. So there's 22,500 credit repair agencies in the country, and there might be 200 that are operating legally. We're one of them. So there are I think there are 212 different laws within the Fair Credit Reporting Act that govern the credit bureaus. And this is a whole podcast in itself, but I'll be as short as I can. The credit bureaus know that they can get away with just about anything. So you might go in and try and do it yourself. And if you don't have every I dotted and every T crossed, they just throw it away. And our infamous CF, Consumer Finance Protection Bureau, during COVID actually came down with a mandate that credit bureaus, if they think your challenge is frivolous, they don't have to answer you. So for almost 2 years, the credit bureaus didn't answer anybody unless it was a legitimate legal dispute that they received via registered mail for the most part.
Wow.
So think about the power that they had. And, but if you follow the rules set out by the FCRA and the Fair Debt Collection Practices Act, also the FDCPA, you can win. It is said that almost 80% of the items on a credit report are there illegally, including the good items.
Wow.
I've found that it's closer to 90%.
Wow.
So if you want to be an entrepreneur or start a business or expand a business or whatever, and one of life's little nuances has got in your way, an extended illness, a divorce is typically the top, a death in the family, or a loss of a job are the 4 top. ones, but you've been a perfect credit risk pre-event. Then the event happens, and for 6 months you're toast. But then 6 months later, post-event, you're a great credit risk too. But for that 6 months, you have to stay in credit prison for 7 to 10 years, and it's not fair. And it's the biggest, one of the top problems in our country right now today. And what's sad about it is they're doing it for money. So let's go back to single mom real quick, then we'll move on. So single mom, perfect credit risk. Dad took off with secretary, left her holding the bag. And now she's got a job now that she didn't have before. She's making money. She's doing everything right, but she can't buy a car for less than 18.99 interest rate. So if you're going to buy a $30,000 car and you've got 700 credit, you're married mom and you have a 700 credit score, you're going to pay $699 is the average today. Now forward and you're single mom and your credit score isn't 700 anymore, it's 600. So for the sake of 100 points, that bank is going to charge you 18.99. So an extra point per month equates to an extra $300 a month. So that $327 car payment is costing single mom $627.
Yeah.
And she's the person that can least afford it. Now, what you don't know is the credit bureaus, this is fact, it's rarely written, but it is fact, is the credit bureaus do everything they can to keep your score as low as it can, because they are in collusion with the banks and they sell the note. The banks sell the note for $18.99, but they give the car dealership 4 or 5 point spiff in cash. So that loan really should be max $13.99, but the car dealer's got to get their spiff. It's a big con. If you have a car dealership and you're going to have to borrow money to buy that car, and you haven't arranged for your loan before you went from Capital One or your local credit union or stuff, you're getting stiffed. Okay, you're going to pay at least $3,000 more for that car over the term than you should. It's usually more like 5 or 6 or 7,000.
Yeah.
Crazy.
It is crazy.
If you get me on that soapbox, I'll go for 2 hours.
Oh, I bet. I love it. I always learn something new, but no, I think I just want those listening. I hear it all the time. People are like, I need funding, but my credit's horrible. And it almost paralyzes people to where they feel like they can't do anything about it. But you're not stuck with your credit score. You can do something about it.
And there's a lot of things that you can do to mitigate. For example, a lot of people want to start a business, and females and minorities are making huge impacts in the entrepreneurship right now. And they are our 3 biggest demographics. Hispanic, Black Americans, and single moms are our 3 biggest demographics starting jobs, which is really encouraging, because when I started this company 19 and a half years ago, it was less than 10% of the applicants. Now it's like 65%. So that's really exciting. It's funny. It was only 1988 that a woman couldn't even get a business loan unless her husband guaranteed it and signed it for her.
Wow. Not that long ago.
Or a family member. If you were single and you walked into a bank and said, I want a loan to open a new dry cleaning store, the bank would say, I'm sorry, that's against the law. And it was.
Wow.
Isn't that crazy?
Yeah.
I get off on tangent again. But the thing is you might feel like you're on a hamster wheel and just spinning and spinning and spinning, but you don't have to. What you have to do is find a credit repair agency, a CRA, that does everything as follows all state and federal regulations, which ours does. And the problem with with a traditional legal credit repair is it's going to take 6 months, depending on what's on your credit, it's going to take 6 months. It's just what it is. You know, I have an email right here that came from our analyst that does our credit here in the office just now. And she says, I have 7 people that were in the 7th and 8th month now, and they still have stuff to do. Would you please call them and determine, you know, what avenue they want to take? So, and it always doesn't get done. We've had people that have taken a whole year. It's finally come off, but it took a whole year to get the credit bureaus to listen.
Yeah.
But my advice would be just find somebody and really research their background and ask them the direct question: what groups are they members of, and are they a legal credit repair agency?
Good advice. Love it. So let's switch topics here. I wanted to touch on your favorite question from last week, which was, I believe it was about equipment leasing versus outright purchasing, right?
Yes.
So I know we have a ton of service-based businesses out there that need a lot of equipment up front. It's their biggest cost in the beginning. So I think this would be great to touch on.
So the question that was posed by one of your people the other day was, is it better off to buy a piece of equipment outright or lease the piece of equipment? So right up front, a leasing cost is going to be probably a shorter term, and it's probably going to be a little bit more expensive. And I don't even want to give you differences because there's a lot of variables with equipment and residual value of equipment and things like that. But let's just say that, you know, people are wanting to go buy a $10,000 piece of equipment, and they can pay for it over 7 years or 10 years at the local bank via an SBA loan, if that's what they choose to do. And their payment is $1,035 a month. That includes interest. And then they also have on their plate the capability of leasing this piece of equipment. It's the same $10,000 piece of equipment, but the equipment lease is $1,200 a month because there are additional expenses. So it ends up, this becomes a depreciation question or a depreciation issue. If you buy something from a bank and you have a bank loan on that piece of equipment, your depreciation schedule normally is 10 years. So you're going to be able to write off of your corporate taxes $1,000 a year for that 10 years. Whereas, because it's what we call a balance sheet item in your financials, it's located on your balance sheet. Whereas if your lease is written properly and it's the proper equipment, there are some codicils there that have to be met. But when you lease, the lease typically ends up being an expense. So it doesn't go on your balance sheet, it goes on your income statement or your P&L or whatever you want to call it. And you get to write off every penny that you paid in the month that or in the year that you paid it. Okay. So, and I screwed up the numbers a little bit, but bottom line is that if you're paying the piece of equipment off via a lease in 5 years, you've fully depreciated that piece of equipment in 5 years versus the bank loan method where it takes 10. So, you know, I always I don't get into a lot of those conversations because I'm not up on the tax laws as much as I maybe should be, but every CPA in the world knows the difference and will instruct you on the proper lease verbiage and the proper type of lease and they'll also you might not need the depreciation. You may as a startup, you may lose money the first year, and depreciation is a negative thing that amounts to nothing. This is more for businesses that have been out there for a while and established, or businesses that are you're going and opening up this brick and mortar because you've already got a contract that every person from the public employees credit union has to go into your store and buy something for some reason.
Right. Yeah.
But it's absolute for your people that are looking at equipment leasing, and we do equipment. It's one of the only other things we do in-house is equipment leasing. But make sure they go armed with their with the knowledge from their CPA or their attorney as what's in their best interest.
Love it. Such a good one. So for those that are looking at getting started with funding, I think you had some good advice last week about how to figure out how much funding they need in the beginning. Any insight there?
Sure. It's funny, Umberto and I were talking about this also this morning. We got in the office at 7 so I could get my work done before the call. What I tell people, and everybody comes in and they're saying, okay, I need to survive 6 months. And I, quizzically say, why only 6 months? And they're like, because I think $50,000 and I'll be at least at break even and I'll be making money. And I'm like, that's very poor planning,
Yeah.
And if it's me, I am taking all of my business expenses for 18 months. And that's what I'm counting on. And then I'm also taking some of my personal expenses, mainly my salary. Because a lot of people will leave their job to work. Some of them will have a spouse or a friend or a relative or a kid or whoever. Somebody will just hire outside managers to run the business. But more often than not, the owner becomes the proprietor and ends up not taking money. And I've got 25 grand in the bank. That'll last me 4 months. Yeah, no, that doesn't last you 4 months.
Yeah.
Okay? I mean, my wife came to me today. She says, "Oh, by the way, the tags for your car are due, and do we have the $2,000?" And I'm like, "Oh shit," or shoot. But it's like, you can edge that out. You can bleep that out.
Oh, it's okay.
But
we do it all the time.
I'm like, well, just put it on this credit card and I'll pay it off at the end of the month. And so she did it for me, thankfully. But the bottom line is that you need to take the salary that it takes to pay your bills plus 18 months of expenses in the business. So, and that doesn't necessarily mean the cost of goods sold. So like if you're opening up a restaurant, your cost of goods sold is going to fluctuate. As you sell, you buy more and you use the money you earn from the sell to buy more. So the cost of goods sold really isn't something you want to include, but all of the other expenses times 18 plus 18 months of your salary is what you should do. So, and what we have found more often than not is that the people usually when they come to me and say 50,000, for example, and for 6 months, and I counseled them, it ends up being 3x 90% of the time. So go get 150,000. And I make it very clear to people, we're I think we talked about last week, business financing, you're swimming in a sea of sharks, and we're one of the only dolphins. We actually want to hear what you have to say. We want to play with you. We want to frequent your business. If it's local, everywhere I go, we don't do chain restaurants in my house. We go to the local mom and pop bar and grill and stuff like that. But you've got to, If you want to go to bed every night and wake up saying, how am I going to pay this bill? Then go the minimum. But if you want to be able to concentrate on entrepreneurship and making your restaurant the very best dining experience ever, then you need to make sure you're fully capitalized. And if you're not, you're going to end up in trouble. And, the thing about it is, just because you borrow $150,000 doesn't mean you're paying on it right away, especially if you're going to get a bank line of credit or an SBA line of credit, or use our credit card stacking platform, which we've already established is the biggest thing going. I mean, and here's the other thing about the credit card stacking: it's 0% interest for 9 to 24 months. So think about that. Not only do you get to play with the house's money, but you get to play for the house's money for free for as long as 2 years. With the average right now being 16 or 17 months. But for 2 years, they'll let you play with it for free. So with that said, you're not paying for that money unless you use it. So your cost of goods sold for your seafood restaurant is buying 1,000 pounds of shrimp for your Friday shrimp fry or whatever. And it's going to cost you $10,000. Well, you're going to have a credit card sitting there that has a $30,000 limit to it, that you make that charge. And then you go back, and after you have your weekend fish fry or shrimp fry or whatever, you take that money, you pay it off, and you go do it again. Every time you revolve that card, you're winning, because it's like going out and getting a new loan that you don't have to pay for. So, and I'm very transparent. I'm like, look, I have a vested interest in getting you as much money as you can, because the more money you get, the more money I make. But I let people know that up front. So please understand, don't come to me and say at the end, oh, you just want me to do this because you're making more money. No, money, I've addressed the money issue right in the beginning. Now, once we've got that elephant out of the room, we're going to go and we're going to talk about what the cost of that money and what it can do for you.
Yeah. I love it. Well, Darrell, this has been so extremely valuable. Is there any last advice or insight, anything you want to share with the listeners before we wrap up?
Go do it. I mean, we're not getting out of this mess we're in unless people like you teach people like the ones that are listening to this and the ones that I deal with every day. I mean, look at it this way. The jobs in this, only 10% of the jobs in this country are created by GE, GM, and Boeing. The rest of them are created by the butcher, the baker, the candlestick maker, the dry cleaner, the printer, the consultants like you, and the money mongers like me. Okay, we're the people that create the jobs. So go out, go do it. But my wife gave me the biggest piece of advice that I could give. And that is this: don't wear every hat. Have an accountant. Gosh, if you can't afford an attorney, go join Legal Shield or whatever it is. Make sure you're well financed and you understand how money works. Nobody understands how money works. But understand how to read an income statement and a balance sheet and what they mean. But just do what you do best and pay other people to do what they do best. At the end of the day, it's going to save you a lot of time and a lot of money.
Yes.
The end.
Great advice. I love it. Well, as you can see, we are definitely pro business financing. We used it to get our businesses up and running, to grow our businesses. And Darrell is definitely the guy when it comes to business financing. If you are interested in, what is available for you, if you just want to talk to Darrell, you can find a form to contact him in the show notes of this episode. You can find that at masterbrickandmortar.com/16. Just fill that out. You can scope out your options with Darrell. But Darrell, thank you so much for your time. I really appreciate you today.
Thank you, my dear. It's good to see your smile again.
Yeah, anytime.
Bye-bye.
Thanks for tuning in to the Receipt Paper Podcast, your go-to source of information for starting and growing a successful brick-and-mortar business. Subscribe to hear future episodes and share this content so that more people can access these valuable insights. If you're looking for more resources to help you with your brick-and-mortar business, visit masterbrickandmortar.com or follow us on Instagram at masterbrickandmortar. Thanks again for listening to the Receipt Paper Podcast. We'll see you in the next episode.